My next guest says the relentless demand for crude oil will take its average price to $90 a barrel in 2011, the second highest on record. Sanford C. Bernstein was the most accurate price predictor for oil last year, and its head oil analyst Oswald Clint now joins us. Thank you so much for coming in the studio, Oswald. There's so much concern, actually, that if we get 90, if we get even 100 average, of course, it's going to scupper the recovery. Are you concerned of the effect the price of oil will have on the recovery in general?
Yeah, I think there's a lot of higher forecasts out there. I think we tend to be a little bit more conservative this year with a $90 oil price level because we are concerned about some of the impacts of today's oil prices. Primarily, U.S. gasoline prices are still $4 per gallon. That's still 3.2% of U.S. disposable income. That's not far away from the 4% in 2008, which became a bit of a critical juncture when those prices started to matter. Equally, in non-OECD countries such as Pakistan, China, Egypt, Bolivia, Iran, they've all been increasing their product prices domestically just over the last couple of months. So I think that's a heavy subsidized part of the world that oil demand grows very strongly. But if prices are rising, I'm a little bit concerned there as well that we could have some demand impact.
Also, why is it actually rising? Is it just a matter of demand outstripping supply?
Yeah, I mean, it's on the fundamentals, we would actually say $90 oil price is a good level. We wouldn't really argue for a higher level because we have a lot of spare capacity. We have almost 6 million barrels per day of spare capacity. That's about 6% of today's oil demand globally. Now, in 2008, we were down to almost 1 million barrel per day of spare capacity.
Spare capacity? What? Is it OPEC that's actually not putting it out there on the market?
Well, it's primarily OPEC. It's mostly all in OPEC, that's right. They have curtailed quite a bit of it in the second half of 2008. They've been leaking some of that back to the market, but there's still a hefty chunk sitting in surplus, and that's an important signal to the market to say, look, we're okay. We have a safety cushion, and prices don't necessarily have to go that much higher. And equally, if domestic prices are moving up for gasoline, for diesel, for fuel oil, it's also curtailing the demand side of the equation. So I think, to us, 90 is a good level of oil prices for 2011.
Is there a risk that actually it's investor speculation driving up the prices if we touch 110, 120?
It is a risk, and unfortunately it's very difficult to prove. Yeah. I think it's the causality between futures and in passive investing and oil prices is inherently very difficult to prove. Certainly we've tried it in the past and haven't been able to do it quite accurately. I think it fuels, as oil prices are going up, more and more passive investing occurs, and net commodity futures increases. So it's difficult to actually capture how much of the oil price is due to investor speculation. I think that is a problem, but it's a part of the oil price that we have to be cognizant about going forward. That's right.
Oswald, thank you so much. Oswald Clint there.